Okay, let's unpack this. Today we're diving deep into the recent filings of EOG Resources, Inc., the energy powerhouse. We want to not only dissect their latest financial performance, but also zoom in on a massive strategic move they've just made. We've got two key sources for you. Their quarterly report, the 10Q for the period ended June 30th, 2025, and also a detailed equity interest purchase agreement. That one's dated May 30, 2025. Our mission for you today is really to pull out the crucial financial nuggets, understand the strategic implications of this new acquisition they're making, and explore the really intricate details of how such a huge deal is actually put together. Get ready for some, I think, surprising facts and insights that go well beyond the headlines. So to kick things off, let's lay the groundwork with EOG's financial health. As of June 30, 2025, what's the overall picture looking like for them?
Right. What's fascinating here is we see a bit of a mixed picture, but generally a strong financial position. EOG Resources, they're a large accelerated filer on the New York Stock Exchange. They reported total operating revenues and other for Q2 2025 at, let's see, $5.478 billion.
Okay. Now, that's actually a 9% decrease from the same time in 2024.
Down 9%?
Yeah. And for the first 6 months, revenues were $11.147 billion. That's down 8% year over year. A big driver for this was, well, a significant 13% decrease in crude oil and condensate revenues. That was impacted by a lower composite average price. It was $68.81 per barrel in 2025.
Wow, compared to?
Compared to $80.58 back in 2024.
Yeah.
Quite a drop.
So we're seeing lower revenues because of those price drops. What does that specifically tell us about, their core business, especially when oil prices are bouncing around like this?
Well, it's interesting. While crude oil revenues definitely saw that dip due to pricing, there's a more nuanced story here. See, crude oil and condensate production actually went up. It increased by 3% for the first 6 months of 2025.
Oh, okay. So they pumped more oil.
Exactly. That added about $169 million in revenue, mostly from places like the Permian Basin, Utica, and the Rocky Mountain areas. And here's where it gets really interesting, I think. Natural gas volumes also increased significantly. They went up to 2,155 million cubic feet per day. That's MACD in the first half of 2025. That's up from 1,865 MACD in 2024.
And gas prices were better.
Much better. Composite natural gas prices rose to $3.17 per thousand cubic feet, up from $2.02. So that really helped cushion the blow from crude oil. And one more critical piece, the financial derivative contracts, they played a big role. They actually shifted from net losses of $47 million in Q2 2024 to net gains of $107 million in Q2 2025.
Big swing.
Yeah, it highlights that their strategic hedging is, well, it's working for them actively.
That's quite a balancing act then. Crude oil prices dipping, but natural gas production and prices up and hedging stepping in. How did these kinds of shifts ultimately hit their costs and, the bottom line, profitability?
Well, the good news on the cost side is that operating expenses were actually lower for both the 3-month and 6-month periods. That's definitely a positive when revenues are softer.
Right.
The cost per barrel of oil equivalent, or BOE, saw slight decreases year over year. It came in at $20.74 for Q2 2025 and $20.93 for the first 6 months.
Okay, so costs per unit are down slightly.
Yes, but, digging deeper, we see some shifts within those costs. Lease and well costs per BOE decreased, which is good. Same for depreciation, depletion, and amortization, DD&A, for oil and gas properties. But general administrative costs, G&A, and interest expense per BOE, those notably increased.
Okay, so not all costs went down.
Right. So ultimately, even with lower revenues, EOG reported decreased income taxes because their pre-tax income was lower. However, their net effective tax rate did tick up slightly to 23%. It kind of implies they're managing controllable costs well, but maybe some fixed or overhead costs are growing a bit on a per-unit basis.
Okay, that makes sense. And what about their cash position, their ability to kind of weather future price swings? They've clearly got strong cash on hand. I saw $5.2 billion. But given that revenue dip we just talked about, is that liquidity truly as robust as it looks on the surface? Especially with commodity prices being, unpredictable. What's the real stress test here for them?
That's a really critical question. And yes, they did maintain a strong liquidity position as of June 30th. That $5.2 billion in cash and cash equivalents is solid. Plus, they have an undrawn $1.9 billion credit facility.
Right.
However, and this is important, cash flow from operating activities actually decreased by $1.471 billion for the first 6 months.
Oof. That's a big drop. Why?
Primarily due to higher income tax payments, lower sales revenues, as we discussed, and also some shifts in derivative settlements. So this is where the sensitivity analysis becomes really insightful for you, the listener. The report specifically states that for every $1 per barrel change in the crude oil price, EOG's net income is sensitive by about $167 million. And their pre-tax cash flows, sensitive by $214 million. That's for the full year 2025 projection.
Okay. And natural gas.
For natural gas, a dill over 10s per 1,000 cubic feet change impacts net income by about $36 million and pre-tax cash flows by $46 million. So, this isn't just abstract numbers. It's a direct measure of their strategic agility. It shows just how vulnerable or perhaps resilient their profitability is to those market swings. It means, yes, they have strong cash now, but a sustained drop in oil prices could, well, erode that liquidity pretty quickly. Makes their hedging strategies absolutely vital for future stability.
Got it. That context is key. Now, beyond the core numbers, I did spot something interesting about how they're allocating capital. Tell us about their share repurchase program. Seems like they believe in their own stock price.
Absolutely. It's a strong signal. EOG is actively returning value to shareholders, which usually signals confidence from management.
Yeah.
Just between April 1st and June 30th, 2025, they repurchased over 5.4 million shares. The average price was $110.59 per share.
So how much did they spend?
That totals just under $600 million. And they're not done. They still have about $4.46 billion authorized for future buybacks under their public plans. And it's also worth noting for you, their principal executive officer, Ezra Jacob, and the principal financial officer, Ann Jansen, they both certified the effectiveness of their disclosure controls and procedures.
Which gives confidence in the numbers.
Exactly. It gives you confidence in the reliability and transparency of all these financials we're discussing.
And one last quick note on their internal workings before we move to the big acquisition. What about their employee stock plan? That's an interesting incentive, kind of linking employee success directly to the company's performance.
It really is. EOG's Employee Stock Purchase Plan, or ESTP, was actually just amended and restated effective June 1st, 2025. It's designed, to give employees a chance to buy company stock at a discount. Specifically, it's the lesser of 85% of the fair market value on the grant date or on the exercise date.
Yeah.
Definitely. And it's set up to qualify under IRS Section 423, which gives certain tax advantages to the employees who participate. Employees can contribute between 1% and 15% of their compensation through payroll deductions during these 6-month offering periods. And the plan limits purchases to $25,000 in fair market value per calendar year.
Why the limit?
Well, it helps ensure broad participation across the workforce rather than letting ownership get too concentrated. It kind of fosters a wider sense of ownership throughout the company.
Okay, so those financials give us a really solid footing on EOG's current state. But the real game changer this quarter wasn't just in their day-to-day operations, right? It's this massive strategic acquisition outlined in that equity interest purchase agreement. This is where things get, I think, truly compelling. So lay it out for us. Who's buying what from whom? And for how much?
All right, this is the big one. This agreement, dated May 30, 2025, it clearly shows EOG Resources, Inc. as the purchaser. They are acquiring 100% of the equity interest in a company called Encino Acquisition Partners, LLC. The agreement just calls them the company. And they're also acquiring 100% of the common stock shares of another entity, CPPIB EAP US, Inc., which is referred to as Blocker Corp.
Okay, Encino Acquisition Partners and this Blocker Corp, who are they buying from?
The sellers are a group. It includes the Canadian Pension Plan Investment Board, or CPPIB, specifically their entity, CPPIB EAP Canada, Inc. Also, Encino Acquisition Management, LP, another one called Encino Acquisition Management 2, LP, and then other Class A unit holders of Encino.
Got it. And the price tag?
The core of this deal has what they call an enterprise value of $5.6 billion. And that purchase price is being paid entirely in cash.
All cash, wow.
All cash. And you should also note the agreement indicates EOG will be responsible for what's called a company notes principal amount of $1.2 billion. This relates to Encino's existing debt, specifically their 8.500% senior unsecured notes due 2028 and their 8.750% senior unsecured notes due 2031.
So EOG is taking on that debt too?
Essentially, yes. It means the total cost, the real economic outlay for EOG, is effectively higher than just the $5.6 billion cash price. It includes assuming that debt.
Okay, that makes sense. Now, you mentioned CPPIB EAP US Inc. is referred to as Blocker Corp. What exactly is that, and why is it part of the deal? It sounds a bit like legal maneuvering.
Well, maneuvering might be one way to put it, but it's quite common. Blocker Corp is essentially a holding company. The agreement itself explicitly states that it has no material operations or assets other than its direct or indirect ownership of interests in Encino Acquisition Partners, LLC, and, activities related to this specific acquisition.
So it doesn't really do anything. No employees?
Exactly. No employees mentioned. This kind of structure is very common in complex transactions, often for tax reasons or legal efficiency. It allows EOG to acquire the underlying interests, the actual operating assets of Encino, partly by acquiring this holding company shell. So EOG gets Encino's assets by buying Encino directly and by buying its parent holding company, the Blocker Corp. It just streamlines the transfer of ownership. Less a shortcut maybe, and more a deliberate, often beneficial legal structure.
Right. Okay. Understood. Now, when you're looking at a multi-billion-dollar acquisition like this, the headline price, the $5.6 billion plus debt, that's one thing. But the fine print, the covenants, the conditions, those really dictate the success and the integration down the road. What are some of the key agreements and rules governing this deal before it even closes? This pre-closing period, it seems like a really critical dance between the buyer and seller.
Absolutely. And if you connect this to the bigger picture, these pre-closing agreements are absolutely critical. They're all about managing risk and ensuring a smooth handover. So, first, between May 30th, when they signed, and the actual closing date, Encino, referred to as the company parties, has to grant EOG reasonable access to its operations, its books, its records.
Due diligence continues, basically.
Pretty much. And both parties also commit to using reasonable best efforts to get all the necessary regulatory approvals, particularly under the HSR Act.
The Hart-Scott-Rodino Act, antitrust review.
Exactly. That requires companies to notify the government, the FTC and DOJ, about large mergers for antitrust review. And EOG specifically commits not to make any other acquisitions that might potentially delay this HSR approval.
Interesting constraint on EOG.
Yes. And the agreement also imposes pretty strict operational restrictions on Encino until the closing happens. For instance, Encino cannot amend material contracts. They can't sell material assets over $5 million individually or $15 million in total. They also can't make capital expenditures over $2.5 million individually or $5 million total unless it was already budgeted for or it's an emergency situation.
So EOG is basically locking down the business they're buying.
Precisely. They're ensuring the asset they agreed to buy remains in good condition and doesn't undergo significant changes before they officially take the keys.
That's a profound level of control EOG is exerting, even before the deal is formally done. What about specific business activities like hedging or asset management? Does EOG get to dictate those things during this interim period too?
They do, to a significant extent. The agreement actually requires Encino to terminate most of its existing oil or interest rate hedges, and any new ones they might enter into before closing.
Terminate them. Why?
Presumably because EOG wants to manage the combined entity's hedging strategy itself post-closing. They don't want to inherit hedges that don't fit their own risk profile or outlook. However, interestingly, there's an exception. Any assumed execution date gas NGL hedges, basically the natural gas and NGL hedges Encino already had in place on May 30th, those cannot be modified or terminated without EOG's written consent.
So EOG wants those specific hedges to stay.
It definitely indicates EOG's clear intent to keep certain gas and NGL hedges, likely because they fit into EOG's own ongoing risk management strategy for the combined portfolio. Furthermore, the agreement includes a pretty robust non-compete clause.
Always important in these deals.
Very. It stipulates that the entity sellers that group, including CPP/IB and Encino Management, they cannot, for 1 year after closing, own or invest in any restricted business. And restricted business is defined basically as an exploration and production company with significant operations in the Utica Shale Basin or near Encino's current operations, especially if that competing business uses similar names like Encino or EAP.
So EOG is boxing out the sellers from competing directly in that key region right after selling.
Exactly. It clearly shows EOG's desire to secure the value of the assets and the market share they just paid billions for. They don't want the sellers turning around and immediately setting up a rival shop next door using their old name and contacts.
Makes sense. So after all this is said and done, post-closing, what does this mean for the landscape? Especially thinking about branding and operations. Will we even, recognize Encino as Encino anymore?
Well, no, not really. It means a very clear separation of identities. The deal effectively dissolves the Encino brand as a standalone entity, at least under this new ownership. EOG explicitly commits that after closing, the entities they've acquired cannot use names like Encino, Encino Energy, EAP, CBPIB, or Canada Pension Investment Board, or any confusingly similar name.
How long do they have to change everything?
They get a 180-day transition period to change the legal names and remove these marks from most materials, like letterheads, websites, things like that. That period extends to 365 days, a full year, for things like oil, gas, and water wells, and the related surface facilities. Signage out in the field takes longer.
Okay, so a clean brand transition for EOG, avoiding any market confusion.
Precisely. And the agreement also covers other post-closing details, like indemnification for the former directors and officers of Encino for 6 years, regarding things that happened before the closing. And it explicitly addresses liability for WARN Act notices.
The WARN Act, layoff notices.
Yes, the Worker Adjustment and Retraining Notification Act. It means they've pre-agreed on responsibilities for providing advance notice if there are significant workforce changes for those employees transitioning to EOG. It really points towards a complete absorption of Encino by EOG, not just, say, an investment where Encino continues as a separate subsidiary.
It truly seems like every single detail is meticulously planned, almost, to a fault in these agreements. What are the critical conditions, the absolute must-haves for this entire multi-billion-dollar transaction to actually close? What could stop it?
Right, the closing conditions are robust. They act as critical gates that have to be passed through. For EOG to be obligated to close, several fundamental representations made by Encino, by Blocker Corp, and by the sellers must still be true at closing. These are essentially core legal and financial statements about the business that have to hold up.
Well, like confirming ownership, no major lawsuits, that kind of thing.
Exactly. Basic foundational truths about the company. And importantly, there must not have been any company material adverse effect since they signed the deal back in May.
A material adverse effect, or MAE clause. Standard but crucial.
Very crucial. It means nothing significantly bad can have happened to Encino's business or its ability to close the transaction between signing and closing. Furthermore, there can't be any new law or government order that prevents the closing. And of course, those HSR Act waiting periods we mentioned must have expired or been terminated.
Okay. And if those conditions aren't met?
Well, if these conditions aren't met, or if there's a material breach of the covenants, the promises made in the agreement, and it isn't fixed within a 30-day cure period, then the agreement can be terminated.
And what happens then? Is there a penalty?
Yes, and here's another interesting detail. In certain specific termination scenarios, there's a termination fee specified. It's $392 million.
Not insignificant.
Definitely not. And importantly, the agreement states this fee acts as the sole and exclusive remedy for damages in those situations. That limits further legal recourse or lawsuits over the failed deal. The agreement even goes so far as to highlight certain disclaimers, like those about the quality or quantity of the hydrocarbon reserves being acquired, using conspicuous text literally written in all caps in the document to make absolutely sure they are legally binding and nobody can claim they didn't see them.
Wow. All caps. It reminds me of those tiny clauses in, like, your phone contract you never read. Only here we're talking billions of dollars and the future of an energy giant.
Exactly. It really underlines the intense level of risk assessment and value negotiation involved in a deal of this magnitude. Every contingency is considered.
So today we've really taken a deep dive into EOG Resources. We've examined their recent financial performance, those shifts in crude oil and natural gas revenues, how they're managing expenses, that robust liquidity, but also juxtapose that with the really meticulous details of this huge $5.6 billion acquisition of Encino Acquisition Partners. We've seen how financial reports tell a story of adaptation in a really dynamic energy market. And we've also seen how a complex legal agreement, like this purchase agreement, lays out every single step, every obligation, every contingency in a major corporate transaction. These aren't just numbers on a page or some boilerplate legal text. They really are a blueprint for how a company like EOG positions itself strategically for the future.
Indeed. And as you, our listeners, reflect on all this, maybe consider this provocative thought. Beyond just the sheer size and the financial terms of an acquisition like this, what does the extreme granularity of these legal documents actually tell us? Think about the non-compete clauses, the specific details on terminating some hedges but keeping others, even the really strict post-closing name change requirements. What does all that detail tell us about the future of corporate mergers, especially in industries that are becoming increasingly complex and competitive? How might this level of, pre-negotiated operational and branding control actually influence the ultimate success and the integration of the acquired company? And maybe what does it imply about the kinds of risks that companies perceive in today's M&A landscape?
Definitely food for thought as you go about your week. Until next time, keep digging, keep questioning, and keep getting well informed.